Good morning, good afternoon, good evening, everybody. Today is May 16th, 2016, a little after 12 Eastern Time. And my name is Jerry Furst, founder and director of InvestorsEducationNetwork.com, broadcasting to you every week here on CapitalDiscussions.com for the week ahead with options and charts. So type in your questions, and you can reach me at InvestorsEducationNetwork.com. And what we do every week is technically and fundamentally we'll take a look at the markets as the week ahead sets up, and then we'll start projecting price, time, and volatility and drill down to potential option opportunities by searching and employing techniques and methodologies. My decision support software of choice is OptionVue, and I also use multiple charting programs and websites. Your questions and contributions to the conversation are monitored and encouraged, and we can even go ahead and pass the microphone to you if you want to go ahead and share your screen and thoughts. Disclaimer is that none of this is financial or trading advice. No matter how good an opportunity might look, do your own due diligence and take responsibility for all your actions. And this part of what I'm doing is part of my larger program, which is using charts to help determine entry, exit price, and time targets. And when you're using options, it's not good enough to just, find a call and a put, or every month put on a morphing iron condor trade or something like that. Every situation is different, and the markets are always changing, and even the tools that we use are always changing. So you have to adjust to the opportunities and the environment that we're in. When it comes to charting and technical analysis, these are some of the things that I'm using: Fibonacci retracements and extensions, high probability chart patterns. Support and resistance levels is the basic foundations of charting and technical analysis. Once you go ahead and draw those lines, you end up with trend lines. You add the moving averages and indicators, and that gives you a little bit more confidence as to where the direction of the market is going and the volatility on the charts. Then you start employing strategies and step-by-step methodologies. You add your tools and software, your knowledge of your order entry platform. You calculate your risk reward, your position size. Then you have patience, do a lot of practice, get your psychology right, have a plan and stick to it, and that gets you to the bottom line of a higher probability of success. And it takes years to get to the point where you feel comfortable that you have a methodology and a system. And even the best professionals in any endeavor have coaches and mentors, and that's something that you might want to consider. You can go to Investors Education Network, and you will be able to see free access to a 30-minute consultation. If you go to Investors Education Network, or you can even go to Traders Education Network, and I'll post that in for you. You can go ahead and get a free 30-minute consultation. Fill out the survey form. All right, so let's get back over to the week ahead. And the first thing that I do is I look, if you go over to the economic calendars on Capital Discussions or on my website, InvestorsEducationNetwork.com, my website has several different calendars, and what you want to do is make sure that you're not caught by surprise of a scheduled event. Econo Day puts red stars and yellow stars next to potential market-moving news events or scheduled events. So Monday, we've already had the Empire State Manufacturing Survey and the Housing Market Index. And today at 4 o'clock is the TIX report, Treasury International Capital, basically import-export flows. Tomorrow, Consumer Price Index at 8:30 and the housing starts. Industrial production at 9:15. All of these are at Eastern Time Zone. FOMC minutes on Wednesday. So for those of you who are relatively new to this, the FOMC, otherwise known as the Federal Reserve, Federal Open Market Committee, about 8 times a year, they have a meeting, and 2 weeks after their meetings, they release their minutes of the meeting to the public. And that can have an effect on the market. In fact, sometimes a very large, in case there's some kind of a message that they're going to either hold interest rates steady or raise them or lower them. Those two events can have a huge impact on the market and the market direction. So I would say Wednesday at 2 o'clock Eastern Time to watch out. Thursday, weekly jobless claims and Fed business outlook. And then Friday, existing home sales. The rig count for Baker Hughes, from Baker Hughes, is keeping a watch on oil. And let's go to some live charts for a second. And oil, as we speak, the West Texas contract trading at about 47.57, up $1.36 today. And you can see the gap up over from the weekend, and coming from 27, now at 47. That's a pretty big move. This is a 5-minute chart. And if I was to go ahead and bring this in and change that to a weekly chart, you can see we hit 27, which I had called that target way back when over here after we broke. First we were coming down to this 43 target. Once we broke below 38, I was calling the 27 target. And we did hit that. And now we're heading back up towards 50, which is easy. You can just visualize that support resistance level on this weekly chart. And so oil is definitely, it's a big component as to what people are going to watch for the economy in general, and geopolitical issues as well. Gold, on the other hand, take a look at gold, how radical it moves. It was trading here at 10 o'clock this morning at about 12.88, and it dropped to 12.77 in a matter of about 20 minutes. And if you notice on this chart, and I can bring this up on my other one, but I'll just pull it up here briefly. For those of you who are new to charts, can you see how simple, if I just draw a trend line, and you'll notice that drawing trend lines with these free charts from Thinkorswim are not as easy as some of the other programs. What I tell beginners is that it's not good enough to just use one charting program, especially just because it's free, from your broker. What you want to do is consider it like a toolbox. You don't just have one screwdriver. You don't have just one saw in your workbench. You have several different pieces of sandpaper, which you use, the right tool at the right time to get something done. And so there's reasons why I would use and have at the ready a different charting program. And what I'm doing here is just showing that, notice the stair-step pattern. See, I can draw this. This is gold right here. This is a very radical move down. But we were at the top of the trend channel. So it wasn't completely out of the question. Now, this is a 5-minute chart. If I pull back and look at it on a daily chart, a 1-hour chart, here's the trend channel I just drew. And you can see that we're really in a much bigger trend channel. Here's the lines I just drew, but we're really still smack in the middle between the upper and lower range of this trend channel that goes all the way back to July of last year. It's an extremely well-formed trend channel, which is now formed. In fact, let me break out my other tool here to draw this. Here you can see that we now have a very well-formed cycle right here. And we have a very well-formed cycle right here. And we also have a very well-formed cycle right here. And what does that add up to? A head and shoulder pattern, inverse head and shoulder pattern. So all I can tell you is that gold works very well technically, and I would say that if price breaks above this trend line right here, there's a good chance it's going to really go a lot higher. Let's take a look at the weekly chart. Clear this off. And why is that important? If you're only trading IBM or some other stock or even just an index like the Russell, because gold is a currency, and it also works very good technically, and you can buy it and sell it in the physical format of coins, bullion, collectibles, jewelry, or you can go ahead and buy and sell it with the ETF, such as GLD, or you can even participate, which I'm not really fond of, the gold miner stocks, but you can participate in the industry. It helps mine the precious metal. So, looking at the weekly chart, you can easily see that this level right here, right where we got to right here, is a support resistance level with congestion. So again, if we can break above this level here, there's a really good chance we're heading from the current price of $1276.70. We could be heading as high as $1440. So going from the current price of $1270 to $1440 using gold futures or just buying the GLD, this is not a recommendation, but it's something that you might want to look at and consider. So let's take a look at let's go ahead and look at the other charts that we have here in the presentation. We went through the week ahead on the economic scheduled news events. Then I like to look at the VIX, the volatility index, and we'll take a look at here. This is the week ahead with the Dow 30. And you can see that at this point, we've got the W pattern in formation, and now connecting these lines here, you can see that the current price, where that arrow is coming right on the support level. And if we were to break that, we could be coming back down here. Remember, we are in May now. It's May 16th. And so the odds of sell in May go away is always something that's talked about. Come on, let me clear that off. And this is what that same chart looked like last month, April 4th. We had this W pattern where it looked like we could have been heading back up higher to 18,400, 18,200 on the Dow. We were at 17.7 at the time. Notice that where we're at now, we are at 17.7, so we're right about the same spot where we were a month ago, and we did get back up to just about that 18,200 point. So looking at the charts a month ago, you could see that the line that I drew right here, 18,200, was hit. And let's look at the live chart of that. This is on the Dow. And so here's the live chart. You can see that 18,200, it got hit right about here. It just got tapped that one day, 18,000, well, 129. But now the odds are, just following the trend, you can see that we're making lower highs and lower lows. So the trend and direction is down, and we've got this triangle pattern, which some people might even call a pennant. So these are the high probability chart patterns. Notice we have right here, we have a double bottom, which formed a W pattern. Once we broke above that midpoint, we went up. And now we've got the run up, and this looks like a pennant flag, which could be a bearish signal on top of everything else to bring price potentially down if we break that support level that we're sitting on right there. So now what I'd like to do is talk a little bit more about potential opportunities, short-term opportunities. Type into the chat, if you would, whether or not you're a short-term, intermediate-term, or long-term investor. And I think that everything is eventually a trade. But let me just get an idea as to where you're at individually. And in the meantime, I want to bring your attention to some of the websites that are out there. Stockcharts.com is one website that you can use where you can get free charts. And one of the things that I like to look at and use is the candle glance groups, where you can also look at market summaries of galleries. We've got the Dow 30 group. They just changed this website here. Predefined scans. Market summary. Why do they keep changing this? Public chart lists. Gallery charts. Nope, that's not it. Okay, so if you go to stockcharts.com, you can go ahead and look at lots of different charts in lots of different ways. And then they've got some predefined groups. Here we go. Select predefined groups. So here we go. If you click that, and I selected the Dow stocks. So here's all 30 of the Dow stocks. And I can go ahead and select whether it's 2 months, 6 months, or 1 year on each chart. What I like to do is point it to 6 months. And what I'm looking for are a couple of things when I look at this screen. I'm looking for high probability chart patterns. And I'm also looking for the general trend and direction of the stocks individually and as a group and as a sector. So what does that mean? Okay, so Goldman Sachs, it's in the financial sector. So is American Express. And so is Bank of America, right? And so is, let's see, Visa is also in the financial services. I can go ahead and see which one of those, is there a similar pattern, and is it a similar, which one is outpacing? And overall, just looking at all of these charts all at one time, I can get a gut feel for what's the general trend and direction of the market. And right now, it looks to me as if, well, some of these are doing good, 3M made a low of 135 back in the beginning of the year, and the same as ExxonMobil, also hit a low of around 72. You can check the archives of the recordings, and I was saying that, you know, in the long run, these stocks will most likely be here 5-10 years from now, as long as the market's here. And so ExxonMobil is most likely going to be a survivor of the shakeouts that'll probably happen with the oil and gas industries. And that was probably a good point to potentially, if you ever wanted to buy ExxonMobil at a discount, it was probably a good point to do that. I'm not so sure about right now. And again, if we're talking about options, you could have sold the puts, which would have, in case you were wrong, if you thought that it was going to go up, by selling the puts, you would at least would have gotten paid by selling the puts, cash secured, saying that you have enough cash to handle the contracts. When you're dealing with some of these big blue chip stocks, sometimes you're not going to get too much premium when you're selling puts and calls. It depends. Depends on the volatility. It depends on a lot of different factors. Options give you options. So the idea is to at least understand that, you know, you have your choice of working with blue chip stocks, and that's a good place if you're a beginner to start. Because at least if you get involved with these big blue chip stocks, you're not just rolling the dice on some penny stock or a very volatile stock like a Taser or a Crocs or some other stock that, you know, could be here today and gone tomorrow. And as you get better and better, you can go ahead and build a portfolio of actively investing. Another website that I use a lot is FinViz, FINVIZ.com. And there's no charge to go ahead and use this website. They keep updating it. It's real nice. They do have a paid portion of it that I've never used. And you've got gainers and losers. You've got chart pattern recognition that they pull out. You have insider activity. This is like the main page dashboard. And look at the earnings. They even have selected earnings coming out after the market bell today. That was Friday, before the market this morning, and today after the bell. And so you can just look at some of these, and just by hovering your cursor over those symbols, you can go ahead and just take a quick glance at some of these stocks. Now you can also, once you create your account, you can also save certain settings, and I can do a screener looking for potential earnings. So I can say, give me earnings over the next 5 days with some of my filters in place. And some of my filters are that they're all optionable stocks with volume over 300,000 shares a day, price over 20. And I can go ahead and look at it from a charting perspective. I've got 30 to look from, and you've got Autodesk. I'm looking for high probability chart patterns or something interesting. You got CPB, Campbell Soup, trending very nicely to the upside. All of these stocks are going to have earnings over the next 5 days. Dick's Sporting Goods, you've got, let's see, and what I'm looking at, like here, Hibbett Sports. And Hibbett Sports, that whole sector, sporting goods is in play. Sports Authority is going to be going out of business, closing up shop. I used to be a consultant in the programming analyst division when they were in Fort Lauderdale before Mitt Romney merged them with some Texas company. And interesting category, because it looks like the sporting goods sector is going to be consolidated, very similar to the office supply sector. And let's take a look at the next page. What I'm looking for are good high probability chart patterns that are setting up for moves. Walmart in a wedge pattern, breaking support. And so right now, I don't see anything coming up based on this scan that's worthy of too much in-depth looking. But what I'm going to do now is I'm going to go ahead and pull up OptionVue. And with OptionVue, I can go ahead and here's the week ahead. What I'm going to do is clear this out. And I'm going to come up to this E over here at the top. And I can do training on OptionVue as well as how to read the charts and use the charts, whether it's the charts from the broker, as I showed you already, the broker's Thinkorswim's charts. I can show you how to use TC2000's charts, which I've already looked at some of the charts here. Or I can show you freestockcharts.com or stockcharts.com. And so right now, I'm getting into OptionVue, which is what I use for decision support. And so this is going to be, we're at the, inside of earnings season. I'm going to click on earnings search. This is part of the free portion of OptionVue, or it's included in the basic package. And so here I've got it sorting for the next 5 days, all option stocks. And I want to make sure that I'm excluding stocks less than $69 and with a daily volume of options, dollar volume of options less than 100, exclude them. And I'm going to insert it. Okay, this little arrow here will insert it into my quote window. So there's the 10 stocks that are coming up with earnings. I'll close that. Here I have an earnings date column inside of OptionVue, and I can right mouse click and sort. So here we've got Home Depot, we've got TJ Maxx, Viasat, we've got Lowe's. So Lowe's and Home Depot, interesting. So Home Depot has earnings tomorrow morning before the market open, and Lowe's the day after that. You got Salesforce.com, Eagle Materials, Advanced Auto Parts, Dollar Tree, and Deere. So those are some good, blue chip companies. For some reason, this is updating right here. Let me go ahead and go into NetView. I want to update my files. I'm going to go ahead and update all of these. And it's very important that if you're using OptionVue or any program that your data source is connected and pulling in your data feed. And what I'll do is that I'll just go to 12 noon today and I'll have everything update. And that way everything is frozen in time at 12 o'clock today. And I can go ahead and take a look at these stocks. And what I want to do, I'm going to show you that we've got the volatility charts. And what I'm going to do, go to NetView. I'm going to go ahead and update all the price charts on the selected files. And by clicking through, watch, here's Home Depot. The implied volatility is 70 on a weekly chart. If I click here at D, that's the daily chart. The percentile ranking is showing me that the implied volatility is at an 80 level for Home Depot. And if I put my cursor here, you'll see that right here, that 80 number there. 80 percentile ranking means that only 20% of the time on this chart is implied volatility higher than where we are now. The odds of us having a volatility crush tomorrow after the earnings comes out is most likely. And what I can do here is go ahead and click on this next button, and I can go ahead and just take a look at, here's TJX. Look at the percentile ranking is 97. Notice that only 3% of the time is implied volatility higher. So I'm going to go ahead and just page through and let it load the charts. And I'm going to, here's Target. Target's under a lot of pressure actually right now for a lot of reasons. And I can bring in the price chart as well. They have their own charting software. It's a lot more basic, but it's good if you want to just look at the chart. But it also has, again, different functionality, which we may be able to get into here today. But for now, I'm really looking at, I'll look at the combination of the actual price chart and the volatility. And my focus is at the 94 percentile ranking. I like the idea of maybe looking at Target as a potential trade. Retail sales has been under pressure, and Target's under pressure for a lot of other reasons that we won't get into. Salesforce.com, again, elevated 75 percentile ranking. Eagle Materials, Advanced Auto Parts, 97 percentile ranking. So the reason why I'm looking, for those of you who are beginners, when you have earnings coming out, this volatility crush is very likely to go from a 97 percentile ranking, where at the right edge, that's actual 40 percentile for implied volatility. The odds of it getting crushed and coming back down to, let's say, 27 is pretty high. So from going from 40 to 27, this 13-point drop in implied volatility is my assumption. With that, I can make some assumptions. So I like looking at Advanced Auto Parts. I like looking at Target. And Dollar Tree, implied volatility is high. It looks like we're inside this. I'll take a look at Dollar Tree. And Deere Industrial Equipment, not going to play with that one. Home Depot would be interesting. Okay, so we're going to look at Target and Advanced Auto Parts. And so if I go back over to my charting program, I'll type in Target. And you can see what I'm using is multiple time frames. For those of you who are not familiar with what you're looking at here, in the middle we have a daily chart. Over here on the right, we have a weekly chart. And over on the left, although it says 1 minute, let me go ahead and bring that up to, let's say, a 30-minute chart. So this is a very good example of the fact that here, Target, which I've already got some analysis on, very good, well-formed trend channel. Okay, and where are we in the trend channel? At 75 right now. We have room to drop down to 65 or so, and we have room to jump up to about 90. That's on a weekly chart. On a daily chart in the middle, you can see that we have this level of support resistance that we're at, and this cycle, or some people would call a rounded top, has completed. So we're right at a decision point. Are we going to drop and break down and complete an even bigger cycle? bringing us down to around 68? Or are we going to bounce and maybe come back up to the 200 moving average at about 77? Or we have a Fibonacci cluster here at about 78. So what I would do is then I'll take a look on the thinkorswim trading platform. I'll look at Target. I've got the market maker move of 3.5 points expected. And over here, implied volatility dropping from 54 to 38. Excuse me a second. So a 3.5 point move in a couple of days could be an opportunity. We'll take a look at that in a minute. Now, some people would just say, you know, hey, if we're trading at 75, and if I think it's going to go down 3 points, that's going to be like 72. So if I buy a cheap option that's going to expire in 4 days, so a lot of times what people might do is say, well, I could buy the 73 put for about $1. Okay. Or I could sell the 73 for $1 and buy the 75 for $1.70 maybe. I'm going to show you in a minute how, because you were asking, somebody was asking about vertical spreads. So in this case, you know, we could do a vertical by selling the lower boundary of where we think something's going to go to, and collecting $1 to 75 cents is about the lowest that I'd want to collect if I'm going to sell an option. So I could see selling the 72 for 75 cents. And by selling the 72 for 75 cents, I'd be able to go ahead and buy the 75 for $1.70, and I've subsidized that. And so let's take a look at OptionVue for a second and see what we're talking about here. If I go ahead and come out here, this is my quote window. If I click on Target, it's going to open up what's called the matrix inside of OptionVue. And what I'll do is hit this button here, and I'm going to bring in a bunch of quotes. And all of these quotes are frozen in time from 12 o'clock this morning. Let's see what happens if I come out of BackTrader. Let's go live here. Okay, so all of these quotes should be live right now. And so what we're talking about here is, number one, I'm looking at the implied volatility. And the implied volatility is extremely high. It's at 93. We're looking at Target, which I have a bias that it's probably going to go down. And I'm showing that thinkorswim says that there's probably going to be about a 3.5 point move when earnings comes out. And when is earnings coming out? If I take a look at FinViz and type in TGT up here, I'll have all the information about Target. And so it's going to be earnings is May 18th before the market opens. So that's today's the 16th. So that means that I have 2 days to put a trade in place. And so if I go back over to OptionVue, and if I'm saying that we're at a 27% 27 implied volatility with a most likely crush, let's say down to 20. So we're going to suspect that there could be a 7% drop in implied volatility. Okay. Now, if we're trading at 75, they're expecting about a 3-point drop, and my charts confirm, these are my charts confirm that dropping down to 70 is probably not out of the question. It's probably a good point. It's probably a good point the price might gravitate to. It's saying right here, notice this is what they call the legend, okay? So right now I have a 3x3 grid right here. And so the market price for the July 82.50 call is 56 cents. The market price of the 80 call going out to October is 2.25. The delta of this option is 33. The delta of this is 15. Okay, the implied volatility, the midpoint, is right over here, and the open interest is in the top right. And so we can see that there's plenty of open interest going into July. Here for earnings, we have lots of open interest. So I'm always making sure that whatever I'm trading, I want to make sure that there's a lot of people with open interest. Notice I'm not alone in this 70 put. I'm thinking maybe I could sell this 70 put trading at 46 cents. I thought it was getting more than that. The 70. Oh, the 70. I was looking at the 72. Okay. So let's see here. Yeah, 45 by 48. That's not enough. What I'd like to do is maybe sell the 72. It has a delta of 26, which is about right, which is about the right sweet spot. So what would happen if I was to sell a 72.50? Let me double check something here. Yeah, they do have 72.50. That might even be better. Most people are trading the 72s because they're even numbers. The 72.50s, you've got the fractional option. So sometimes those are the better ones to sell because you sell them, it'll be harder for somebody to buy it back. And what I want to do is come back up here and define and say all strikes. I say okay. Okay, that updated it. And so here, the 72.50 is trading at about 91 cents. The bid ask is 89 by 93 cents. That's nice and tight, 91 cents. So if I was to sell 10 of those 72.50s, I can collect $1, 90 cents. Let's call it 90 cents is what it is. So if I sell, or if I want to buy the 75 put, which is at the money, that's going to cost $1.77. Now using OptionVue, I can see that my net requirements is going to come out to about $929. Okay? Following me so far? Any questions? Okay. So here, if I hit the Analyze button, this is what my risk-reward graph is. I can drag it over, and I can add other time decay lines. But I'm also going to go ahead and say, notice the volatility change that's implied is a minus 28. I'm saying, well, I don't know if there's really going to be a minus 28. How about a minus 17? Okay. And now, one of the big things that I'm always looking at, and I would never trade options without understanding the risk-reward graph, or the delta and the gamma and the theta, okay? These are if you take a look right here, you can see a lot of numbers on the bottom. Profit and loss, delta, gamma, theta, vega. my margin maintenance requirements. And if I click on these lines, watch, these numbers are all going to change, okay? If I'm expecting, for example, 2 days from now is the 18th. So that's the third line right here. So I can go ahead and click on that. And that's saying that by putting $929 at risk, if I really think that we're going to drop down to about 72, okay, I can stretch this out, by the way. Let me go ahead and stretch this out. Come on now. Here we go. So 72.02. If I put $929 at risk, this is where we are on the risk reward graph. And so right there, you can see that we have right here, we're going to be risking this much money, if in case I'm really, really wrong, to make this much money. And that's in 2 days. However, if I'm right, and if I wait until expiration, I could be making this much money. And let me, by clicking on this, at expiration, I would be making about $1,500. That was a $929 excursion. And if I hit the D button, it might be hard to see there. Let me go ahead and show you this calculator. That's just really, it's a huge, it's a tool that I use all the time. If I was to say that today plus 2 is the 18th, and if we were to drop down to 72, with a 17% drop in implied volatility, it's saying that here, if I bought that trade right now, 89 cents is what I'd collect selling the 72.50 put. I'd spend $1.80 buying the 75. Okay, the theoretical value of that option would go from 89 cents to $1.42, and the one that I bought for $1.80 would go up to $3.17, giving me about a $700 gain, which is a 74.5% yield in 2 days. Now, if I held it to expiration, which I can say X1, okay, then that becomes $1,500 gain, which is 166% yield. Not bad. A few things have to be right. So let's review. Number one, I have my time, my projected date, which is either going to be in 2 days or at expiration right. I have to have my price target right. I have to see price drop to 72. And I have to see the implied volatility drop about 17%. Let's take a look and see what happens with no implied volatility change. In this case, it doesn't make a difference at expiration, but it might make a difference with minus 17%. It might make a difference, but it doesn't. So there's no implied volatility change based on these calculations. But these are the three-dimensional chessboard that you have to use when you're trying to figure out and work with options. You have the price of the underlying, in this case, target stock. You have the date, which is the time that is going to take place, and how much time does it take to get to the price, and how much time do you have before it expires. And then you have volatility. And is the volatility going to go down or not, and will that have an effect on the bottom line? Now, I don't know about you, but if you have strong convictions, and this is not, once again, I'm gonna jump back over to my PowerPoint presentation for a second. Again, this is not trading or investing advice, but this is strictly educational in nature. And this is what I do with my clients. I help them. They have an idea. They think the target's going down with earnings. What would I do? I can go ahead and show them how to use OptionVue. I can show them how to look at the charts. I can show them how Thinkorswim might potentially help them in their decision process. And I can give them multiple options to potentially trade. Notice this is $929 for this trade. Okay, I'm going to go ahead and show you the Trade Finder function. And I really like this a lot because it'll allow me to take a look at option opportunities that, you know, as smart as I might be or think I might be, the computer can crunch a lot of numbers a hell of a lot faster than I ever will. So if we go ahead and put on a target of 72, and we say that that's going to happen within 2 days, so that's today plus 2 is May 18th with a 17% drop in volatility. Let's say that I'm going to use, because we already have this one example using $930. So let's just make it an even $1,000 excursion. Okay. And if I say that I want to take a look at vertical spreads, because one of you is saying you're interested in vertical spreads. So I'm going to say, show me all of the options if I just bought some puts just by themselves, and show me the vertical debit spreads that are available based on this assumption of price, time, and volatility. And the dog is excited. All right, go get him. Go fetch. So here you can see best case return and the probability of profit based on my assumptions and based on the formulas and the inputs coming in to OptionVue. And here they have some interesting trades that I never would have thought of. Look at this. Here's a vertical spread using the first week in June, selling the 69 put for 85 cents. It's a decent price. And buying the 92 cent 71 put. Okay. Well, that's saying that with $1,000 at risk, I would make potentially $4,200 by May 18th. So I'll click on the Analyze button, and I'm just going to store that. Then I'm going to go ahead and do that for a couple of these. All right. Now, just because, you know, notice here it says, what's my net price? It's only going to cost me 7 cents to put on one of these spreads, 7 cents times 100. So that's $70. So if you have strong convictions about this, you can paper trade, or you can actually go ahead and, you know, take a couple of bucks and see, you know, how it works. Paper trading is the way to start out, and then finding trades like this that have very little cost, 7 cents, 8 cents, 18 cents. We're here, look at this. This is about 100%, 200% yield. Okay. This trade here says that I could sell 50. Now remember, you've got your commissions involved. Always add that to, and OptionVue does that. If I hit D, you can see the commissions is going to cost me $85 in commissions to put on this $1,000 trade. But watch this. It's saying that May 18th, if we go down to 72, the options that I sold for 65 cents, which are the first week in June, the 67.50 put, they will hold some of their value. They'll go from 65 cents to 56 cents. So I'll actually have a small gain of $65 according to the calculator. And the puts that I bought for 83 cents will go up to $1.30, giving me a $1,900 gain, giving me a 198% yield. Okay? Now, watch this. This is 50-50, right? June week 1, 67.50 in the 70.50s. Okay? So what I want to do is, let's go ahead and bring up the June week 1, and that's the 67.50 put and the 70.50 put. 67.50, 50. Now I need to bring in a few more strikes, so I'll say give me 30 strikes. Okay, how about 35 strikes? Down, boy. Hey. Okay. 70.50, 67.50. So here's the 70.50. If I right mouse click and say that I want to buy a vertical, it's going to go ahead and let's go ahead and, for now, just buy and sell 10. It says buying the 70.50s, selling the 67.50. It's telling me that it's going to cost me about 25 cents to put this trade on. And the interesting thing about this trade, too, is that we actually have a few days. This is good for 18 days. So even if it doesn't go in our direction immediately, it does open us up to the possibility of having something else come up. But again, this is strictly an earnings trade. It's a roll of the dice in some respects, but it's also a fundamental play on Target and the retail sector. So if we go back over to OptionVue here, notice here it's saying that the difference between 83 and 65, if we go back over to the Trade Finder, it said that it was going to cost us about 18 cents. So watch this. Let's say that we'll just do this for a live demonstration. Let's say that I say, I want to do this trade for 18 cents. And I'm going to direct my trade to the Chicago Board of Options, CBOE. And I'm going to go ahead and do this. I'm going to buy 10, sell 10. If I click on Confirm and Send, it's telling me that it's going to have a negative effect of $204 on my account. It's not a big deal. Okay, the risk reward is good. Could potentially make 200%. Okay. Now I'm saying that I want to get it for 18 cents. That's what OptionVue said I should be able to get it for. If I go ahead and send this order, you'll see that the order is sitting there and it should be monitoring. There's one order. It says that it's a limit of 18 cents. So I'm not putting it in at market, right? I'm saying I'm willing to pay 18 cents for this spread. And it says that the value is really 43 cents. And watch, this is something that a lot of people don't know about, the market depth. If I go ahead and right mouse click and look at the market depth, and if I go ahead and pop this window open, what you have here is the bid-ask spread of the two legs. This is the June 67.50 and the 70.50. And it's also got the combined, notice that you've got a bid and an ask on this vertical between 8 cents and 80 cents. Now this is interesting because technically I put in a bid well, I'm in the middle here. So right now, my order is just sitting and waiting. And did I expect to get filled at 18 cents? Not really. So I thought it was, it's a good demonstration of, how to potentially find a trade, how to go ahead and, let the market come to me. I didn't think I'd put this trade on. If I could get it for 18 cents, it's definitely, it's a great trade at a great price. Notice there's no bids over on the 67.50 puts, and that's what's putting pressure on this not to fill. Now, one of the other things that I can always do, if I was really fighting for this, I could adjust my trade. In the meantime, what I'm going to do is I'll just cancel the order, and that's that. If I go back over to OptionVue, that was this 2000. What about this one here? This is the 71 by 69 for 7 cents. All right, let's try that. 71 by 69. So I'm going to go ahead and buy vertical and the 71 and 69. And here, this is the midpoint is between 9 cents and 69 cents is the natural. So here, if I go back over to OptionVue, saying that I should be able to get this for 7 cents. So you have to realize that, whenever you see a whole bunch of contracts here, the likelihood of actually getting filled at those prices is not as good. But it gives you a great idea as to what, hey, put $1,000 at risk, make 4,000 in 2 days. Okay, maybe you'll pay 15 cents for it, So if I double click on this, okay, what happens is it loads this trade into the matrix. And you see it right here. Buying 117 and selling 117. It says that my net requirements is $880, but my commissions on this is ridiculous, $178 in commissions. And I'm not sure if it's something I really want to do. This is just for demonstration purposes. So what if I was to say, give me just 10 of each? So if I buy these for 83 cents, the 71 put, and sell 10 of the 69s, this is what my risk-reward graph looks like. And this is a fantastic looking risk-reward graph because here you can see that I'm only going to risk this much money to potentially make all the way up to here. So what we can do is take a look and 72.50. Hold on one second. So what we've got, I'm looking for it to drop down to 72. There's something a little bit odd that's got me puzzled here because, well, here, okay, that's what it is. If we drop down to 72, we have to make sure that we get rid of it in a couple of days. But at expiration, 72 is a loser, according to this. let's hit this detail button. So if we hit 72 in 2 days with a 14% drop in volatility, okay, it's saying that the difference between these two options is like only a couple of cents apart, which is like, it's ridiculous. It's not really valid. So let's take a closer look at this here. Yeah, the spread here, this is the problem. The spread that the computer's looking at is 18 cents by $1.66. And so that spread is, it's not giving you a real accurate, but it might, huh? Here you got 79 by 88. This is 18 cents by $1.66. 69 by 71. Well, so if I sell the 69, buy the 71, let's say that I give them let's say that I give them 10 cents. What would that do to my trade? Okay, so let's say that inside my simulator account, if I convert the trade, go into my transaction log, let's say that I make this thing where I'm buying for 96 cents. It's going to cost me 10 cents for this trade. What does that really look like? Okay. This is what the trade really looks like if I got filled at 10 cents. So instead of making $600, I'd be making about $300, a 234% yield in 2 days. Not bad, if it works. Okay. So let's see if I could go for 10 cents. Okay. It's going to cost me about $130. Come on, let's see what happens. You never know. You just might end up on an album. 10-cent debit. I'm going to send this over to the SIBO. Confirm and send. See, it's going to have a net buying effect of 125 bucks. And if I hit the send button and monitor, you can see here that it's got a 10-cent limit that's sitting here working. It's coming down 33 cents. And if I go ahead again and right mouse click, look at the market depth. Again, this is something a lot of people don't talk about. They don't know about, they don't use. But here you can see the market depth. I've still got the previous trade here. Okay, let me try this again. Okay, so here you can see the bid is 1 by 67 cents for the spread. My bid ask is 79 by 88. So that puts that at about 85 cents. And this is 21 by 80. So that's about, let's call this 50 cents. So it's about a 25. If I was to bring this up to 25 cents, I might be able to get filled. Let's just take a look and see what would that look like if I got filled for 25 cents. Now I'm really pushing it because going from 10 cents to 25 cents, this is not the trade that I originally looked at. But what we'll say is if we paid $1 and collected 75 cents, not $75. Okay, now I'm forcing a simulated trade that's going to cost me 25 cents. And now if I look at my risk reward graph, it's still not bad. You know, it's still showing that I've got about a 1-to-1 risk reward where I'm expecting price to potentially drop to 72. So here, everything below the 0 line, this is my risk from here to here, and this is my reward right here, which is almost a 1-to-1. And if price goes below 72, so much the better. So here I'm risking $280 to make potentially $400, or $280 to make $150 in 2 days. So if I really wanted to push it, notice the price is coming down to 32 cents. You know, if I really wanted to, if I wanted to chase this, I could come up here, I could cancel and replace the order, and I could bring this up to say that, you know what, I'll give you a quarter for it, okay? If I confirm and send, buying power effect, 150. It's going to cost me 250, 275. If I hit the send button, so now you can see that I'm up here at 25 cents limit. The order is sitting at 40 cents, 39.50. So they're still not going to give it to me. And so this is how you fight for a trade, and it's just, you know, just an example. If they gave it to me, all right, so I'll take it. If they don't give it to me, there's lots of other trades out there. As long as you've got cash, in your account, there's always another trade down the road. So I canceled that order. And so there's an example of order entry on Thinkorswim. There's an example of looking at market depth. There's an example of using the charts and using OptionVue, using risk-reward graphs, and also how to use the Trade Finder. I can also sort by probability of profit, as well as other things. Extremely powerful tool. If you do want to take the plunge into active investing and trading, the first thing you really need to understand is where is price likely to go to? And then if you're going to use options, you really need a tool to help you make that decision, the best decision that you can make. Don't chase prices. Don't get excited about pulling the trigger on trading. And so we've covered quite a lot. What I want to do is just remind you, charting and technicals and learning options, it's not a get-rich-quick thing that happens overnight. Here at Capital Discussions, they have a options mentoring program, but also I teach charting and technicals. This is all the stuff you get, 12 mentoring sessions, 6 months of OptionVue, all kinds of other goodies. How do you get there? You go to the Capital Discussions website, and you go up to education. You go to one-on-one mentoring and coaching, and This is how you sign up or find out more information. And the only promise that we have, the only promise that I'll make is that if you work at it, you'll get better. And you'll have somebody with an unbiased opinion trying to help you increase the odds of success. I've been doing this for over 15 years. Take advantage of it if you want to learn. You can go ahead and go to the Capital Discussions website, click on Get Started Now, or you can go to my website, Investors Education Network, traderseducationnetwork.com. You can fill out the survey and get a free consultation with me. So I hope that you can see with a little over an hour in this presentation, a lot of information covered, and that's just in 1 hour. Any questions? All right, very good. So at this point, I'm going to go ahead and wrap things up. And again, my name is Jerry Furst, founder and director of Investors Education Network. And today, it's May 16th, 2016. It's 1:30 Eastern Time. Feel free to contact me. Go to the InvestorsEducationNetwork.com website or CapitalDiscussions.com. See you again next Monday at noon Eastern Time. Over and out. Bye-bye.